Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you've started your portfolio but need some help continuing to grow, 2022 REB Buyer's Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host, Smart Property Investment Show. Hope you're well. I hope you've pulled yourself off the floor after that 50 basis points increase a little bit earlier this month by the Reserve Bank of Australia. Everyone knew there'd be more rate rises coming, but I think it threw a few people the size of that, and a lot of the banks were pricing in sort of 40 basis points, but big 50, I think an indication of how the Reserve Bank actually wants to handle this upwards rate cycle. A lot of people giving criticism to the Reserve Bank. Some people giving them a 1 out of 10 in how they've approached things, seeing that a lot of Australians have probably made investment decisions based on the fact that the RBA last year was saying they wouldn't raise rates until 2024. So I think there's a lot of people who are a bit angry, a bit jittery about that, but it gives you some sense for the economic climate they're in right now in terms of inflation. And we've been chatting about the reasons for that inflation on this particular podcast. Don't need to go into it again, but the Reserve Bank's got in there early and hit rates hard at the front end. And I think a lot of commentators are saying, well, it's good to go early and then soften it rather than just these 0.25 ad infinitum for the next 6 to 9 months. That said, a lot of Australian investors are now considering their portfolio, working out whether it's still the right thing for them, how they're going to react to it. And I think that's going to be definitely a trend in the theme of this podcast for the next period of time to ensure that you see the opportunities in all rate environments and all rate cycles and what you can do to insulate your portfolio and also look for those opportunities out there. I'm going to be getting a whole bunch of people on who I know do this every single day. One of them, Sam Gordon, he's Director of Australian Property Scout. He joins me today. We're going to have a chat through that, plus get a bit of a pulse check on where he is on his portfolio journey. Sam, how you going?
G'day, Phil. Good, thanks, mate. How are you?
All right. Not too bad at all. Now, the last time we got together, you'd hit some number.
I did.
In properties. What was it, 30?
I had 31.
31.
So 31 while still 31, yeah.
Okay. When did you turn 32?
I turned 32 in Jan. So I think, it must have been since Jan that we haven't caught up.
Yeah.
It's been a little while, mate.
There you go. Time flies, mate.
It does, mate. It does.
Well, what do you reckon about all these rate rises?
Yeah, it's come. I'm the same as you, mate. It has come hard and fast. Probably a little quicker than I thought the way it would go up. But all good things come to an end. Emergency interest rate levels were going to have to come up at some point, and it's happened, mate. They're moving. So
yeah, well, let's get into that a little bit. But beforehand, mate, what's the latest with the Sam Gordon portfolio? Still buying? You stopped? I think enough's enough, mate.
Mate, I did. It actually it piqued I think the topic for today's chat, because I did a lot of kind of review and assessment of my portfolio, over the last 5 or 6 months since we last caught up, and it made me kind of have a good look over it. I've gone through and I've sold a couple of things, and then I've kind of gone through and I've been buying a bit as well. So as you know, when the old renovators pop up that are or the deals that are a bit too hairy for most clients pop up that I've obviously tackled before, I accumulate and pick those up for myself in my own portfolio. So, mate, I'm actually up to 36. So I've kind of bought one a month since we last spoke, and I've flogged one of them off and one property off, and I'm in the process of selling another one at the moment as well, mate.
What are you selling?
I'm selling properties to be fully transparent, man. Properties in Sydney that have had a lot of growth, essentially doubled twice since I've owned them.
Yeah.
But I've had ridiculous growth over 8 to 10 years. Yields have done okay, but they're very much lagging compared to what they're worth. Huge chunk of equity in them, and I'm selling those to reinvest into other markets that I think have still got a lot of potential for growth. I think those Sydney markets that those properties were in are going to come back. One of the ones the one that I did sell, that market has already come back a bit, so I kind of timed that well. Quite honestly, mate, I'm reinvesting back into my own portfolio as well. So there's different properties that I've been putting off renos for a while I was accumulating more, building secondary dwellings, developing different sites, things like that. So a lot of time and efforts kind of and funds and resources are going back into that as well.
Yeah. And you see a lot of investors have been doing that and are doing that at the moment. They've been around for a while, significant amount of capital growth. So they're looking to, is that same growth going to continue on those properties over the immediate period of time? Probably not. So it's about cashing it out and redeploying that capital somewhere else where you can pretty much emulate what you've done. That's really, really smart business, Sam. And, where are those places? Like western suburbs of Sydney sort of way?
Down south, southern Sydney. Yeah, I owned a fair bit of property down there. So
yeah,
it's had a great run, mate. But yeah, ultimately, especially with the COVID transition of people moving out there, I saw it happening late last year, and I kind of called it as I thought it was going to kind of wrap up. So I took the first one to market because I was thinking when that kind of dies off and peters out, people are more than likely going to move back to the capital. So that intense heat that's there was probably going to subside, and we have seen that happen. Yeah. So
you've got a bit down Mittagong way, right? Yeah.
I grew up kind of downish that way, down that way. So
I was having a chat with someone yesterday at a barbecue, and they I can't remember the name of the suburb. When you're coming into Mittagong, in from Sydney, it's on the left hand side, one of those newish sort of suburbs. I can't remember.
Renwick.
Yeah, it could be there. Yeah, and they've been renting there, and the house that they rent, they could have bought it a couple of years ago for like 800, and then a house I think 3 doors down, pretty much the same. They've had to buy it at like 1.2 or something or other. Yeah. It's gone nuts down there, hasn't it?
Yeah, it's crazy. We did when I first started buying, and I used to do buy and builds down there. I'd buy land and that's super cheap and build on them, and I'd be doing them for 350, 380, that sort of money. And in the Sydney boom 2013, 2017, they kind of doubled out to like 700, 750. And then I was doing a few of them again when the market lulled in 2019. We're doing them for about 550, and they're going to be worth, low to mid sevens. And in 2 years, they went from low to mid sevens to about 1.2, 1.25. So it was just ridiculous growth. And that's why I don't think it's sustainable for those markets to sit there for one, but to have any more growth during that time. So it was a good time to cash out, mate. It's, had a great run and it's a great area, but
it's like you've priced in 5-10 years of capital growth into where it is. So if you're buying that now, you're probably not going to get the sort of huge uplift, right? Okay, if you're an occupier, but as an investor, is a big question mark over those type of assets now for you?
Yeah, definitely. The ones that I have good cash flows on, like I've got some that are dual locks and stuff down there, and they're great. There's some that have got a bit of future development potential on them as well. They're all worth holding. But your standalone sort of homes, I think they've done their dash, and they've had a great run. But velocity of money, how much I've got tied up in there, I prefer to pull it out and put into something else. Both the capital and the debt, you're redeploying both of them.
Yeah. Well, what's going to happen with places like Mittagong and Bowral? Within 2 hours of Sydney, a lot of people sort of this work from home or need to be in the office 3 days a week. Do you reckon it's going to hold its value, that whole sort of collective area, those sort of regional areas?
I reckon they'll come back a tad, but I do reckon they'll hold pretty firm. They will come back a bit though, because there was a ridiculous demand and craze for them, like things hitting the market and selling straight away for really, really top money. When the heat comes out of that, they always do come back a bit, but I do think they'll hold. There's a huge amount of people that have relocated down there, like so many people that I knew, even from up around the Shire and stuff, relocated down to the Highlands, just for that lifestyle change. Bigger blocks, more room, more space. There's great schools down there. 10 years ago, mate, half the shops were empty when you drive down Mittagong, Bowral, Mossvale, but now they're all full. So there's a lot more.
High streets are heaving, right? Particularly Bowral's a bit fancier than Mittagong, but down through Mittagong there, it's still. It's good pubs down there, Mittagong.
There are, mate. There are. Sampled a few.
Mate, we should do a pub crawl one day down that main drag of Mittagong, end up in Bowral. Be pretty fancy. Go past the KFC, but anyway. No, but it's interesting, and I know a lot of property investors have been chasing these sort of more rural, regional lifestyle locations within the Sydney or within the capital city sort of commuter belt, and it's still really attractive, mate. Central Coast is going berserk still, which is essentially the same as the Southern Highlands. Similar distance. It's on the coast, obviously, but it's got its own hinterland. Maybe the schools aren't as good up that way, but all these things work. So you're selling them off. What are you buying? Tell me about what you're buying.
Mate, it's a bit of a mix. I've always been one that picks up the deals that are a bit, like I said before, a bit too hairy for clients, like $50,000 to $100,000 sort of reno deals. I'm still a big fan of, Brisbane, Adelaide, Perth. I still think all three of those cities have still got a good run left in the tank. They're not at these huge, double boom sort of levels like a lot of Sydney and Melbourne are at. Mm-hmm. So I still think they've got a lot of growth left in the tank. Yields are still good. Vacancies are still super low. So those combined with a few regional areas, mate, I've been buying, just a lot of those renovator style sites, dual occupancy sort of style sites where you can build, double rents and all the rest of it as well. Things that you can drive that really strong net cash flow return. That's what I've been really focusing on. So, looking at things that are going to insulate the rest of the portfolio and allow it to, keep providing a good, strong passive income. I think that's one of the big things, mate. If you can take an asset that's had a huge amount of growth over the past couple of years and you sell it and redeploy both the capital and the debt into something that produces a really strong net cash flow, mate, you can't go wrong. It's not so much your head's going to be above water. It's going to keep providing that surplus income ongoingly. So that's what I really have focused on, especially the last 6-12 months.
And that's an important bit that a lot of property investors are doing. We'll talk about some of those strategies, but just on the buying this reno type stock. So it's about sort of manufacturing equity, right? You buy a place, you might need to tip 50, 100 into it. The idea is that you should be able to double, or whatever your equation is, double your spend on it in terms of capital growth or rentability on it. And there's pressure on rents right now means you can get a pretty good uplift on that sort of stuff. But how you go and finding tradies and, increased cost of materials and all that sort of stuff is impacting the reno appeal?
Yeah, look, it does make it more difficult, and it does have to make it more selective with what we pick up as well. So there's different sites or there's different deals we pick up that when it comes to structural, that's when you can run into some serious kind of headaches around trades and stuff. But sometimes you can have a cosmetic reno that runs into the 30s and 40s as well. If you're extensively renovating, potentially a trashed house or something like that needs new kitchens, 2 bathrooms, full refloors, paints, everything. It can add up pretty quickly to being a fairly hefty sort of priced reno. But with all that sort of stuff, mate, I've been doing these for years, both for myself and obviously for clients as well. So we've got some really good deep trades that look after us. It's not like they're all leaving us just because the market's turning hot, and they can obviously charge more. Yeah, we've been quite lucky and quite fortunate with that we've got quite good and deep reno teams that we're still leaning on today. So, and
you like to reno in sort of your local area. It doesn't matter where it is.
No, it doesn't matter where it is. Yeah. I don't do my own renos anymore. I used to do enough of that. So,
yeah, things change. That's cool. So the whole idea of assessing your portfolio is pretty critical right now. Let's have a chat about that. We'll go to the break beforehand. Stay with us, everyone. We'll be back in a moment.
Ever wondered how you can invest like the top 1% of Australian property investors? Henderson Advocacy has been at the forefront of helping everyday Aussies improve their financial freedom. So if you're a savvy investor or someone just starting out on their property journey, give Henderson Advocacy a call today. Head to www.henderson.com.au. Don't invest alone. Invest smarter.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show, and with Sam Gordon. He's director over at Australian Property Scout, good friend and long-term participant on the Smart Property Investment Show. Sam, we should do a flashback episode one day where we actually listen to you in your first podcast here when you were skinning rabbits, or I can't remember what it was. Maybe that'd be quite good fun. We'll do that in a couple of years.
Yeah, 100%.
And see if you're on the button there. Whether success was all there, it's just bubbling away, watching it happen in our eyes. But so you've gone through your portfolio and assessed it and sort of tried to recalibrate or harmonize it for this market. How do you do that? Like, what's your approach to doing that?
Mate, the first thing I look at is overall is the markets. So which markets am I in, right? And which markets do I think are tapping out for growth? The easy way is to assess those, and then how much then the properties that are within that market, which ones do I want to hold long term? So like I was saying before, I've got ones in there that are development sites and cash flow deals. Cash flow deals I'll hold forever. Development sites, I'll develop them when the time's right to do that. But when there's other properties that are in there that have had significant growth, and I think that market's tapped out, then it's time to, if there's a huge amount of equity in there, especially in the market that we're looking in now, like, is it worth pulling out $500,000 in equity to retain that property? Or if it's done its dash and probably won't grow again instead of 10 years, is a better option to sell it, pull out all that equity and wipe out that debt and then recycle that into other deals and other markets. So the market is the first thing you look at. And then other things could be, there's people that could potentially be tapped out with debt as well, and may not be able to get any more. They may be in a market, say like Brisbane, that's had a significant amount of growth, and yes, it may still have more growth in the tank. But if they have maxed themselves with debt and they can't actually accumulate any more, and those properties are low yielding, like, what is there within that portfolio that they could potentially, do something to drive a higher rent? So like something like your renos or adding a secondary dwelling or something? Or is there one of those that's had so much growth and has got such high debt and such low yield that you could sell it and then go put that into a different market, maybe a regional that's still at a low point at cycle that has a lot of growth to run, and you can get a really good rent, like a duplex in a big regional centre, or potentially migrating it even into Adelaide or Perth, where you can get a better yield and the market may be at a lower point in the cycle as well. So there's a lot of different things to kind of factor into the equations when you're looking at it. But everyone's different, and really, the rents and those yields on everyone's individual portfolio is really the big thing that comes into it. Forecasting and making sure they're not going to have to make a call when it gets to the end. Say a few interest rate rises come in, you want to make a call when you kind of backs against the wall. You want to forecast and put that in nice and early.
And how's your debt level at the moment? Are you still got plenty of capacity to borrow, or by recycling, you're sort of keeping your debt positions at a similar sort of level?
Yeah, that's a big part of it. So like I haven't bought in probably 6 years above 80% LVRs. I'm always putting in 20% deposits, always renovate with cash. And a big part of it is selling down when the time's right, cashing out and recycling that around. I think I sit at about 50, in the high 50% LVR.
Okay.
On my personal
what's
portfolio.
the size of your portfolio now? Do you share that anymore, or is it too big? Too many zeros?
It's about 18.5 mil now.
Okay. All right. Okay. So it's good LVR position, plenty of fat there, and you're still a young bloke. What about your mortgages? Are you all interest only or P&I, or how do you go about managing all that stuff? Which is a huge headache.
Yeah, it's a massive mix. So I went through a massive restructuring of the portfolio late last year because you could still get really good fixed interest rates as well. So I was kind of going through and fixing different things, especially like really high yielding cash flow deals. I could fix those for 3 years at a really low P&I rate and just leave them on P&I and let them kind of take care of themselves and pay them out. And then there was others that were I got properties that I call bread and butter deals, right? Bread and butter to me is like those assets I was talking about before. Have really good growth and then sell them down in the peak of a market. I see no real need to reduce debt on those properties because I'm going to sell them down at a certain point anyway. So I leave those as interest only, let the market peak out, sell them, again, recycle that capital and the debt away. So
assessing your portfolio, then you got to look at where your properties are in a cycle, where the properties are in terms of their own maturity inside of your portfolio, and then sort of long-term debt play for yourself, whether or not you can take on more debt or whether or not you probably max out on debt, and therefore it's just a matter of shuffling the deck differently. It's pretty complicated stuff, right?
It can be, yeah, 100%.
You enjoy doing it with clients?
Yeah, I love it.
Your favorite bit?
I love it, yeah. Because it's funny because, like you say, and to people thinking from an outside, I guess, sense that it's difficult or complicated, but quite often there's a few properties that outperform growth wise than others, and if they've got low yields, it's a pretty obvious one to have a really good look at and assess. These ones look like they're the ones to cut. Which one or which ones do I cut from that as well? Yeah. It's more the asset selection after, though. You can't then go sell a 2% yielding one and then go buy a 3% if you were going to cap that anyway. Start looking towards 6-7%ers and things are going to keep you moving forward if that's what you want to do. And
what's your view to the cycle at the moment? we all know rates going up. I sort of mentioned beforehand, 50 basis points last raise. Whether there's more coming immediately, who knows? But expect there to be more. And we've been chatting about this for a while. Guess what? Rates will go up. We're in that period right now. So it's not a bad thing that rates going up. It's just a natural market cycle. It is a bad thing if you've over leveraged yourself and you find yourself struggling to pay your mortgages. Now, this is a show for property investors and not for owner-occupier Australians who are just buying a house with a picket fence. It's about people who are looking to make a buck out of property. So we often see the world a different way. And fortunately, the banks, for most investors, unless they've fiddled their numbers, put a bit of a premium in there on interest rates anyway. It was 2.5%. The big thing last year was they lifted up to 3% buffer. So if you're getting a 4% rate, they were essentially looking at your serviceability at 7%, well, 6.5 to 7%. So there is some natural buffer put in there. Australians' balance sheets are as strong as ever before. There's more savings or mortgages offset than ever before. So hopefully most Australians have been diligent enough to prepare for rate rises, and hopefully most property investors have got those buffers in place, because it's absolutely critical if you are going to maximise it. When you look at most people's portfolios, Sam, if they're sort of a new client of yours, how many people are actually like redlining that far where, the straw that broke the camel's back, where one more tiny little thing or $20 more in terms of cost of living increases, that the whole things come tumbling down? Is there that many people redlining it, to give us some perspective?
No, not really, man. I don't get too many. You get some that are flying pretty close to the sun, but most people, are smart enough to keep themselves a bit of a buffer there. Even if it's sometimes a great thing to do is just do an equity release buffer, and you just sit it in offset, and that just gives you that buffer there. But existing clients, we always target nice high yielding assets, right? So we're always sitting in the positive cash flow territory. So no one's, especially not at the moment, no one's coming anywhere near that. You sometimes get some people that come in and you shake your head and you go, mate, what were you doing when you bought all those? Because they might have got sold into the hype of going and accumulating, 10 super cheap high yielding units, and they look like they're high yielding. But when all the strata and everything comes out, they're actually costing them a fortune. So you sometimes get those sort of people. I actually had a client who came to me with that a few months ago. He wasn't redlining though. He was okay, but he just had a couple of real bleeders that just weren't performing at all. So I went through and we kind of axed those ones out, and again, redeploying the debt and the equity out of it. But no, you don't, because interest rates have still been so low for so long, we're not at that point where people are going through that red line point yet. Yeah. I think in 12 to 18 months, if people haven't, done this, assess the portfolio and so off what they need to, we might see a little bit more of it. So, but no, not at the moment.
So you reckon you're going to move quickly, move now while you're at the start of this cycle. Therefore, you can prepare for how you go about capitalising on this cycle, rather than being a victim or a negative consequence of this cycle, right? That's the mindset you probably need. Yeah, definitely. And I think, again, it comes back to what markets are your properties in. If your properties are in Sydney or Melbourne, now's a great time to assess. And if it's the right thing within your portfolio to shift those on, then now is a great time to look at offloading them. You're not going to be wanting to look at it in 6 or 12 months. Now's the time to kind of get rid of them. So, well, I want to talk about where you should be looking, and let's get into it. I know you're going to be super cagey on me, but we'll see how we go. Let's go to another break. Back in a moment, the Smart Property Investment Show.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Welcome back, everyone. Phil Tarrant from the Smart Property Investment Show with Sam Gordon. Now, Sam, you're talking about buying new joints and redeploying capital in markets which are going the right way. We all know Sydney and Melbourne is starting to come off the boil. And also, to put that into perspective, also, the last sort of 12 to 18 months, some of these markets have gone up 25 to 30%. So to come back 5%, even 10%, that means you're probably still 15 to 20% ahead of it over a 2-year period.
Yeah,
and
definitely.
They're talking about sort of it's coming off. But I think, since the numbers started getting recorded back in the 1800s, prop in Australia. I think it's grown about by 6.5 or thereabouts % year on year.
Yeah,
compounding for the trajectory of the property markets in Australia. So, 6.5% versus 30% is obviously a big gap there. So things don't work in a linear fashion, and that's the art and the science for most property investors, is buying in the right market at the right time to get the uplift that you're looking for. And to your point, you've had properties that have doubled twice in certain markets, and now you're selling them down and redeploying that capital. So where's the next best place, Sam? Is it Brisbane, Southeast Queensland? That's what everyone's talking about still.
Mate, I think there's plenty of locations that are still worth investing in and still worth buying in. Mate, Southeast Queensland's still got a lot going for it. Brizzy's still got a bit left in the tank. It has had a very, very good run. There's some clients that we bought for 18, 24 months ago that have literally doubled or gone very, very close to doubling. We obviously made a nice chunk on the way in, but the markets have done a lot. But there's other places to look. Even within Queensland, there's a lot of really strong regional markets working right up the coast. If you have a look at some of the vacancy rates at the moment as well, they're absolutely crazy. Some of these areas, down under 0.5% and closing. So I think there's some great opportunities and prospects through there as well. Understanding those markets and the market dynamics create some really good opportunities as well. Where can you again generate your dual incomes? Where can you do renos that are going to, the really big disparity between unrenovated and renovated properties to get really good equity uplift and rental boosts? And I think understanding those markets and knowing where to pick and where to target is going to be really crucial, and can yield you some great results. Mate, Adelaide's still on fire. It was a funny one. I've been investing there for a fair few years now, and everyone has kind of like had it on the back burner and didn't really talk about it for ages. And then like the last 6 to 12 months, everyone's finally realized what a strong performer that is. So that's really on the fire. And I think it's probably halfway through its cycle. But I think it's still got a lot left in the tank. And Perth's the same. Perth's another one that a lot of people are very wary of how cyclical that market can be and has been in the past. But I think there's a very big difference this time around. I think it's a very similar market to the 2004 to 2007 boom they had back then. I don't think it's the same as the mining boom in 2013, 2014. It's very much an owner-occupied driven boom. So I think it's going to be I think it's got a good run ahead of it as well. So, and again, yields and vacancy rates in all 3-4 of those areas that we're talking about there. Vacancy rates are super, super tight. Yields are still strong and still performing well. So I think a lot of people are worried about these interest rate increases as well, but like we're seeing very, very strong rental growth. I'm talking month on month rental growth as well. So that's something you're targeting the right areas. You're getting insulated by that as well. So that's something that we watch very closely. I think you've known, man, we've been doing this for a long time. You and I are chatting about this stuff, and positive cash flow is very, very important to me and to us. So it's something that I'm always really keeping my eye on and watching where's having really strong rental growth as well. And that's, in a nutshell, kind of a lot of areas we're targeting as well.
When you talk about positive cash flow, do you consider that not counting the principal payment of the mortgage, as in the interest only part of the mortgage plus all the other costs, but not the principal?
Yeah. I don't include principal, man. I've got a strategy where it was like we were talking about before. You have your bread and butters that go through their growth cycles, and I don't worry about paying off their debt. The reason I do that is redeploying capital sometimes can be actually reducing debt on your cash flow deals. So if you're building out bread and butters and cash flow deals, you're selling off your bread and butters to pay out your cash flow deals. So I don't worry about reducing debt during the accumulation phase. It comes through the consolidation phase as you sell those properties off. So I don't worry about it at that point as I'm building it out.
Are you living in a perpetual sort of consolidation accumulation phase? You're still young, you've got plenty to go. So you're doing both at the same time, right?
Yeah, definitely.
Yeah. And that's just rebalancing the portfolio, harmonizing the portfolio, whatever word you want to use it, but it comes down to perpetually assessing the portfolio, and you're being a positive. How do you find the time to do it? Because I can't find the time to look after my own portfolio, let alone what you do for a living is helping everyone else do it. Are you the plumber who's got the leaky taps, or are you doing it pretty well?
Nah, I didn't mind okay. Man, I think You're 100% right there, Phil. It's what a lot of people miss. People think it's like one strategy that fits everything in property, but it's not. It's bread and butter, which is growth properties that you may be forcing different values on. And then there's cash flow deals and you're building them out. And then there's consolidation. There's some people that say you buy and never sell. But I'll tell you right now, it'll take you 30 plus years to retire if you never sell. You have to sell at certain points to reduce debt and consolidate and recycle capital. It's all part of the game. And if you have this fluid building portfolio like that, that's how it grows and gets so big. It's a beast that compounds. If you do it one set way all the time, it will take you a long time. But if you have very fluid and a lot of different strategies in the portfolio, including consolidation, it'll keep building. So
you still seem pretty excited about it all.
I love it, mate. Yeah. You don't get to 30s, you're still buying a property a month if you don't love it.
Yeah, God. Use the same broker for everything?
Yeah, I've been using the same broker for about 5 or 6 years now.
Wow. Yeah. He must be good.
She is good.
Yeah, she.
There
you go. Give her a shout out. What's her name?
No, I don't want to get swamped.
Look at him. But there you go. There's the dichotomy of being a successful investor and also buyer's agent. You keep your supply chain pretty close to your chest, right? Because
have to, mate.
Then other people can get uplift value from it. And I get that all the time. People are it's like fishing spots, right? You speak to a fisher and they go, "Oh, I was out here," and I go, "Oh yeah, it was near there. Give me the coordinates." No way, right? They hold it really tight, and your supply chain, your tradies in particular, right? Get a good tradie. It's a simple thing with tradies. Get a really good tradie, pay them the day they do the work. And I tell you what, when you call up saying, "Oh, can you prioritize this job?" Guess what? They're probably going to come and see you first.
Yeah, 100%.
Just real simple tips of the trade.
You look after people, they look after you. It's simple.
Yeah,
mate.
That's good. So what are we going to talk about next time we get together? Sam, it's going to be this sort of, is it Armageddon ahead of us because of rate rises? Do you reckon this is the death of property?
No, definitely not. Mate, you got to look at we're at emergency interest rate levels. We'd never seen 0.1% as an interest rate before. We're just going back to a level of normalcy. So not everyone can be touted as an expert, in 12 months because the next 12 months are going to be different. You need to know what you're doing, and you need to know how what you're doing well. And I think it's going to be. I'm looking forward to it, man. It gets back to I've always done quite well as an investor, so I get back to being who's actually quality, not just the old barn door approach to shoot anywhere. And
there's a bit of that. It's been around. Anyone could have been a successful investor over the last couple of years, particularly in Sydney, where prices have gone nuts, or certain areas of regional Australia. So we're just getting to a normal market. It means you're going to have to try a little bit harder to get it right.
It'll be smarter.
That's it. Smarter. And this is also, I think, this particular upward cycle should be an interesting one because the last time it happened, there was very, very few buyers agents out there. So this is the first time that we've got an upwards rate cycle where there is a lot more buyers agents. So my view is that the balance of power and the influence of the buyer's agent will only be more amplified in this particular market cycle, where you're going to want to start, it's going to start mattering what you pay for stuff. And negotiating it, where beforehand, very little in terms of negotiation. This is the price that you got to pay for it, and that was it. It was really about the asset selection was key. But now, asset selection is still key when it comes to buying property. But I think buyers agents are really going to be helping on the negotiation side of things. Actually finding, we're going to get back to the bit where you can actually find bargains. I think they haven't really existed, over the last couple of years. I mean, how many people have gone, "Oh, Sam, I only want to off market." Under market value property, go, they're not really there at the moment.
Well, funnily enough, mate, that's still what we hunt, on the daily for clients as well. There's always the opportunities there. The days of the 50, 60 grand below markets, they're gone. They've been gone for a little bit now, but you still get discounts. You work hard enough, you still get the discounts. But I am looking forward to, a little bit more of a quiet market. This is the thing, people getting scared, but realistically, do you really want to be buying when everyone's out there buying, or do you want to buy when it's a little quieter? You can negotiate harder, get better deals, a little bit less
phone calls from agents these days. They're calling, "Oh, Sam, how you going? Just checking in, see what you're up to. What are you up to? What's going on?"
Getting a few more.
Do you reckon the agents are getting better? Because I know they're a bit jittery. Their job's just got a lot harder.
Yeah, it definitely is.
And it's a lot of agents listening to this. My tip: make friends with your local buyers agents. They can be a great source for moving well-priced assets quickly. And that's the name of the game.
This is your tip to agents?
Tip to agents.
Could you maybe
friends here? How do you make friends with Sam Gordon? Just give you the best properties, or you take you out, wine and dine you, give you, I don't know. You probably eat pretty fancy food these days, no doubt.
Definitely not, mate. I'm still living on YouFoods meals for lunch.
Yeah.
Good steak, man. Good steak and a beer.
You got to keep it lean, literally. It's good, Sam, mate. We're going to get you in more often. I do like chatting with you.
Likewise,
get you in the
mate.
studio.
Likewise.
I reckon what we need to do is play back some extracts of your first ever podcast.
The rabbit farm.
And then comment on it. I reckon that I'm going to get the guys to work that up, mate. That'll be good fun.
All right, mate. I'll fly down for the next one, and we'll do it in person for sure.
Right. We definitely do that. Sam Gordon over at Australian Property Scout. You can go and check those guys out. If you want, how do people find you, Sam?
Mate, AustralianPropertyScout.com.au. It's the easiest one. Pretty active on the socials these days as well. The Wires Wednesdays, hot tip of the week.
Yeah, what's all that Wires Wednesdays? Mate, you're a social celebrity these days.
Just a bit of a laugh, mate. You know what it's like. You got to be a little bit different. You got to have a laugh about it. But just trying to deliver some good content in a light-hearted fashion, mate. That's all it is.
That's good, mate. Go and check it out. And you can watch it on the Facebook, right, or the Instagram?
Yeah, Facebook, Instagram, mate. It's all there.
It's all there. Look at him, social media guru, Sam Gordon. Thanks for your time today, mate.
Thanks, Phil. Appreciate it as always, mate.
Nice one. I hope you enjoyed that, everyone. Lots more of these chats. This is the sort of environment where, because we're moving into this new upwards rate cycle, I'm going to get a lot of interpretation around it from people I know. One of the good things about the job that I do is I can pretty much dial into anyone in Australia when it comes to property. So I'll ask the questions that you want to answer. You can email the team, actually, if you've got anything that you want to find out. editor@smartpropertyinvestment.com.au. We'll start doing some Q&A episodes because there's a lot of people with a question mark out at the moment going, have I missed the boat? Should I wait investing in property? What should I be buying? All this usual stuff, and we'll get stuck into it. Remember to check out smartpropertyinvestment.com.au. Quick favour for me, wherever you listen to this podcast, if you leave a little review for us, I know the team really love it. They get a real kick out of knowing that what we're doing is actually helping you on your wealth creation journey. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment guide today at purepropertyinvestment.com.